Good afternoon or good morning, everybody. Welcome to another Fintech Nexus webinar. We have an all-star cast for you here. This is going to be a fascinating discussion we're going to have over the next hour or so. My name is Peter Renton. I am chairman and co-founder of Fintech Nexus. And we're going to be talking about digital lending trends for 2024. It's the first 2024 show we've done. And I think we're going to talk about many of the hot topics here in fintech. We're going to touch on, AI, automation, embedded finance, and much, much more. What we're going to do now is just kick it off with some quick introductions. So, Lewis, why don't you go first?
Great, thanks, Peter. Good morning, good afternoon, everyone. I'm Lewis Garner, so I lead Provenier's customer success business for Europe.
Okay, Rod.
Hi, everyone. I'm Rod, the CEO at LendInvest.
Okay, Val.
Good afternoon, good morning, everybody. I'm Valentina Christensen, the Director of Growth and Communications at Oak North.
Okay, and last but not least, Christoph.
Hi, I'm the CEO and co-founder of Ivoca.
Okay, so let's kick it off by getting right into the hottest topic, I think, that's in technology these days, and that is AI. So basically, I'd love to touch on all of you here. How are you using AI today? How are you operationalizing it? What trends are you seeing when it comes to AI in digital lending? Who wants to kick it off? Val, go for it.
So, I mean, look, we've been using AI and ML models pretty much since day one, predictive analytics in terms of our scenario analysis, for example. So looking at how businesses we lend to may fare in different scenarios, whether that's, if interest rates rise to X, what does that mean? If a COVID lockdown lasts until this long, what would that mean, and which businesses will be impacted? Portfolio risk management, regulatory compliance, and also most recently with our first ever the publication of our first ever TCFD report, which I'll leave to the audience to Google on their own time if they're not familiar with TCFD reporting, but using our climate product on climate to look at the risk in our portfolio and also report on our disclosures for scope 1 to 3 emissions.
Okay, Rod, what about you?
So LendInvest's a fintech lender focused on UK mortgages. And the area that we're using AI machine learning model the most is actually on our loan portfolio management. So during the lifetime of a mortgage, as we collect ongoing data relating to that mortgage, how does it change the likely behavior of that mortgage through time? And we then use that to apply more or less focus to a specific loan. So that's, I guess, the key area has been in and around asset management. We're looking at evolving that model into using it for the actual credit lending decisioning itself, but currently not applying AI to the actual lending decisioning. The other area that we are using AI is through a talkative AI plugin. We're currently training it on our lending criteria. So hopefully our brokers and borrowers through time will use that chatbot plugin, and a lot of the quite basic criteria questions that come through manually to our business currently can be picked up and answered. So two of the ways in which we're using AI and hoping to evolve it going forward.
Interesting. Okay, Lewis?
Yeah, so I think from our experience, we're supporting clients on how they operationalize their AI and their machine learning. So we're seeing pockets of adoption, certainly not wholesale across all of the client life cycle yet. We're seeing lots of testing, particularly in kind of the personalization of customer experiences. So you get more into credit lending, but I think it's fair to say there's a lot more to go at in terms of how we use AI moving forward.
Christoph?
So we have made financing available to about 100,000 businesses for about 3.5 billion. And therefore have over the years really accumulated a lot of data across small businesses and their activities. And I distinguish between data science and artificial intelligence. So we're very heavy users of data science across the entire business, may it be from acquisition to recruitment to operations. But where we really apply artificial intelligence is in our lending and scoring algorithms, as they're self-learning based on information that they receive from our customers, so repaying or not repaying, and that is automatically fed into recalibrations of our model as and when the model detects signals that warrant a change in the respective weighting, and that is happening in a fairly continuous way, and really is through artificial intelligence and self-learning.
Interesting. So let's go a step deeper there and talk about data sources, because any kind of data science needs data sources that to help analyze. So Lewis, what new data sources are coming on board for lenders right now?
Yeah, I suppose before we get into new data sources, I think the world is your oyster when it comes to data. I think one of the challenges that everyone faces is how we operationalize it all in a fair and consistent and compliant manner. And I think a lot of orgs are still getting to grips with how they use what is currently at their disposal today. Mm-hmm. I think if you push me on kind of the new data sets, I think some of the alternative financial data around kind of utility data or rental data, I think we'll start to see that playing more of a key part. And then move into kind of some of the social and behavioral stuff. But I guess that links back to how do we use that in a fair and compliant and consistent manner.
Right. Okay, what about others? Val, what are you doing with data sources?
Yeah, so I think actually kind of on the social and behavioral, I mean, I think the fact is that obviously there's going to be certain types of data that you will use for every customer, but then there's certain types of businesses where different types of data will apply. So for example, if you're looking to do a loan to a restaurant business, you can go on and look at review data online. And you can fairly easily source any mentions of things like food poisoning, for example. Maybe there's nothing that's come up in the press on that, but if you see quite a few reviews saying that they've had a dodgy tummy afterwards, that might be something that you want to ask the customer about and just say, oh look, I read some of these things, just want to know what you guys are doing about that. And it could be a very simple response, and maybe they say, look at our food hygiene rating, you can see we're very good. Another example, as I know it's been all over the news, is bed bugs, right? Again, if you see something in hotels about bed bugs and there's lots of complaints there, that might be another thing you want to ask about. So it can be very helpful in terms of finding some of the things that could be potential red flags further down the line that could cause reputational challenges, or even other plans the business might have, right? And maybe there's a forum or somewhere where they've discussed opening in another city, expanding a team, launching a new product, and that doesn't appear to be in the plans that they've shared with you, and you can then query that and see, was that something that they had planned, and did they scrap it, and if so, why? Is it still a plan that's in process? So it does require delving a little bit deeper, but depending on the type of business, it can be very, very helpful, and those alternative data sources can paint a much clearer picture of the business.
Interesting. Any others?
Yeah, I'll come in here. So on the mortgages side, I guess on part of the challenge is just the sheer amount of data that we're collecting on each and every case. So for a UK mortgage, you're collecting data on a customer. We do a lot of buy-to-let lending, so there's often a corporate vehicle in there. You've got the real estate itself. There's a ton of different data sources, and I guess we collect that data through a series of APIs, through bureaus, through fraud detection systems, through land registry, and ultimately on each loan we're collecting around 100,000 data points. Wow. So the bigger challenge is making sure that we're processing and focusing on the useful data that we're collecting, and very much with the types of property lending that we do. So I guess more complex underlying property situations. We're still at the point where actually we need a human making the ultimate decision. So we're analyzing a ton of these data points through APIs, but ultimately trying to present a case in a way to allow a human to make an ultimate lending decision. So I think in the property space, there's still some way to go before we get to fully automated lending in the more specialist areas.
Interesting.
And I think I think that's reaffirms the point of saying that actually getting to grips with what we've currently got, I think is still a challenge for us as an industry.
Yeah, makes sense. Okay, so I want to go to another hot topic, ESG, and this is going to continue to be more important for all types of lenders. Val, you already touched on it, so why don't you sort of talk about what you're doing with ESG and how you're doing it in an authentic way rather than just, greenwashing, as they say.
Sure. So I think the first thing is we've been, as I say, we published our TCFD report. So we, within that, included a number of very punchy targets. So we've put that out in the market. We've said to the world, this is what we're aiming for. And those include being net zero for our scope 1, 2, and 3 emissions by 2035. We are actually already net zero for scope 1 and 2. Obviously, scope 3 is the really challenging one. And, we feel that because of the technology we have, because of the fact that we're not encumbered by sort of legacy technology. We don't have a history of lending to highly polluting sectors such as oil and gas, that we can be more ambitious than perhaps some of our larger peers who are typically aiming for about 2050 for net zero. In terms of doing it in an authentic way, I think, look, there's two sides. One is the businesses that we're lending to that kind of put sustainability at their core. And I think about customers from Oaknorth's perspective, Virtu Homes as an example. So they build ultra sustainable net zero homes. And that's sort of the core of their proposition. And they sort of charge a premium. And sort of their customers will typically be those individuals who are very eco-conscious and want to live in a home, a green home. So those businesses that we're lending to them and helping them to grow that proposition and build their business. Then there's businesses where we're saying, okay, how can we help them on their transition journey? So one of our customers, for example, they deliver money to ATMs across the UK. They have a fleet of about 350 vans. Lending them the money to make those 350, to change those 350 vans, replace them with electric vehicles. It's obviously quite a big investment for the business. And so then it's how can we provide them with the capital and enable them to do that? And then they'll operate in a greener way. And that's obviously where we're focusing on scope 3 emissions, which is the emissions from our customers. So I think it's having those conversations with customers. Right at the moment, what we do is we have as part of our onboarding, we have a survey that customers fill out, and that gives us an idea of how far along are they in their transition journey, if at all. Some have very, very clear plans, and they may be, this may be because they're certified B corporations, or as I say, because they put sustainability at the core of what they do. Others have absolutely no idea where to begin, and will need a lot of hand-holding. From our perspective, we're not sort of saying if there's a business that comes to us that's we feel would be a challenge from a scope 3 perspective, we're certainly not saying we're not going to lend to them because that would be bad for our scope 3 emissions. We're saying, how can we work with that customer to help them transition? And our aim is to have for trading customers or C&I customers to have by 2028 having at least 75% of those customers with a transition plan in place. And for our any new property that we fund, for those properties to have a plan, either they are already at this stage or they have a plan in place to get to an EPC rating of at least a B.
Okay. Others plans for ESG for 2024?
So I'm focusing on the green lending side again. We launched our first green mortgage products a number of years ago. offering two things. One, a cheaper rate to companies with properties with higher energy efficiency ratings. But I think more importantly than that, offering our best incentives to customers that were improving the energy efficiency of their buildings during the lifetime of their mortgages with us. It's been very successful over a number of years. We've got to as high as 50% of our mortgages coming through on our green products. We have seen some drop off more recently as certainly for landlords, which had residential landlords had a deadline that was coming up very quickly in 2025. Governments recently rowing back from imposing in the UK the such timescales for upgrading the environmental efficiency of their buildings. So we are seeing the market actually respond to that, and borrowers slowing down the rate in which they were improving the efficiency of their buildings. But I guess for us, it's been around have simple products that reward customers that are doing the most for the particular buildings that they have, really.
So we actually have an interesting question that's just come in. Christoph, do you want to add something before we go?
Yeah, just say ESG, the ESNG, each of them are pretty chunky and big topics,
right?
In their own right. But on our end, we see that mental health is a big problem for small business owners, and we offer all small business owners free of charge access to mental health support. So we've been more active, from a customer perspective, if you wish, on the social front. From a company perspective, we are net zero, and have done quite a bit of work to understand our footprint as a tech company. And from a governance perspective, we really focus very much on diversity of thought and making sure that Iwoca is a welcoming place for anyone who can contribute in helping us achieve our mission, and have done lots of work to pave that way and become better at it.
Right. So before we move on from this topic, there's an interesting question that just came in here from the audience. AI is consuming relatively a lot of energy. How does this fit in with ESG goals? Anyone want to take that?
I mean, look, I think it's like anything with the journey to net zero, in the same way that I know obviously plans have changed recently in the UK, but we want obviously more drivers to be driving electric vehicles. That's going to require a lot of mining of lithium to create the batteries needed in electric vehicles. So in the short term, we need to probably have there'll be a lot there'll be a larger carbon footprint in terms of the mining to get the lithium, but then that's for a sort of long-term benefit of hopefully more electric cars on the road. So I think for some of these things, it's going to be short term. There may be a spike in the carbon footprint of businesses in certain areas, if they're deploying AI in a material way. But then hopefully you'll see those gains within the years in a sort of order of magnitude as things progress. So in 5 years' time, hopefully you'd see the returns on that investment. But I think it's a very difficult balance, because I don't think you'd be able to achieve the long-term goals without making some seeing some of those short-term spikes.
Right.
It's just my.
Okay, so Christoph, I want to turn to you, and I want to talk about lending products now, and your lending products. Particularly interested in how they're becoming more adaptable to your customers. You work with a variety of different customers. What are you doing there?
Sure, we're happy to give you more of my thoughts on this. So if you look back, it's been 12 years since I founded the company, so I've seen a fair bit of the evolution in fintech lending. And really the first probably 6-7 years was all about building the infrastructure to be able to make the number of decisions we do at scale and with that high level of consistency and discrimination. And so that, we have made a lot of progress on this. It's a phenomenal infrastructure that we now have. The focus therefore is now gradually shifting in understanding really the features that businesses want from a credit product to become ever more relevant to ever more of their use cases. And so if you think back, the world of banks, if essentially you have an overdraft and a 5-year term loan, and that is a fairly rigid set. So where we are at is that we offer customers to choose between the features that work for them. Maybe they want to have an interest-only period for a while because they might be importing or buying stock, which then they sell after 6-9 months and have no revenues, over the first few months. So maybe they need that flexibility. Or other people might want to repay their loan as a percentage of their revenues rather than in fixed installments, so that they can manage the risk better of selling slower if anything was to happen. And so you can see that there are many more features that you can introduce in the lending proposition, which currently is just not happening in the mainstream finance, because it's very difficult to tackle that level of complexity at the checkout level. And so a lot of the innovation that is now coming from us is also based on that, and that is really only possible once you have the infrastructure that we've built that is powering all of the data processing, all of the decision making, and then ultimately also can offer that choice so seamlessly to our customers.
Okay, so I want to move on to automation, and particularly when it comes to automation of credit decisions. And this is something that I think we've made a lot of progress as an industry, I think, but there's still a long way to go. Who wants to kick it off? Maybe Lewis, do you want to talk about what you guys are doing to help automate credit decisions?
Yeah, sure. So I think consumers are driving the need for these automated decisions. In my mind, I think we potentially set out from how do we save money as organizations by straight through processing? But in terms of the expectations on consumers now, I think that automated decisions are no longer reserved for those lower ticket items, right? So it's an expectation that we can service that. And I think from a technology perspective, we've got a role to play in how we allow organizations to make quicker, faster, straight through decisionings to satisfy those needs. I think that in terms of the role that Provenir play, we look to provide the platform that gives people that ability to build those decision flows and act upon them and change them quickly.
Okay, so what about the lenders here who are, I know Christoph or Rod, do you want to kick it off?
Yeah, I'll kick it off because in a space in property lending, which I guess is quite different to consumer or business lending, but on a straightforward mortgage from a high street lender, it's a scorecard lend, and it's an automated credit decisioning, and so these straightforward mortgages flow through and they get stuck in other parts of the lending process rather than the credit decisioning itself. So there's still a lot of friction in the process, but the credit decisioning itself is automated. What we're trying to do is pick up and cater for the customers that don't go through the straight through processing for the banks. So automation for us is a double-edged sword. We automate everything to the nth degree. We end up as the computer says no high street lender. And so what we're trying to do is, I guess, reduce as much friction in the process, reduce the points of decisioning for an underwriter, but allow, I guess, skilled underwriters to make informed decisions based on data analyzed and presented to them in a certain way. So we're sort of ultimately love to get to the point of fully automated credit decisioning, and I think we will for a number of our products, but recognize fully that we could end up as the organizations that we're trying to avoid being, which is the computer says no lending institution.
Right. Okay. Christoph, I know you've done a lot of work here. What can you tell us sort of what you're seeing as far as, or how you're kind of bringing automation into the decisioning process?
Yeah, first of all, I'd say we're lending amounts from £1,000 to £500,000, and so in this spectrum, automated decisions play different levels of relevance. We have been doing fully automated decisions for many years now, and I would sort of caveat, first of all, there's a myth around what actually an automated decision is. So in our world, an automated decision is actually the one that someone can draw down funds from without any further intervention. And we have often spoken about our personal best. Our personal best is 1 minute and 37 seconds currently from a customer sending us an application or starting the application process, better said, to money deposited in their bank account. That does tell you it is an automated decision, automated funding. It's all fully automated, 100%, and that works really well for some of our customers. And then the second bit where we're doing enormous work is where we are phasing in manual intervention or manual intelligence. It is in a completely unbiased way, and that's an area where we're improving every day a little bit to make this ever more unbiased. And so no decision is taken actually by a human, so all decisions are automated. But then in some of the decisions that the system has taken, there is information that is provided by a human because it's just too complex for the system to read. And so a lot of work is around the process of how that information is fed into the system without any human bias. And that's just an infinite amount of work that will always remain and will always be improving and will always be living and breathing, and factors and information will change over time. So that's just one of our biggest BAU development areas.
Right. And Val, I know you operate in a very different market than IWOCA. How are you bringing automation into your credit decisioning?
So we're not, basically. We bring automation into a lot of the parts of the lending process, but Oak North, the loans that we do are, whilst we start at sort of 250K, most loans are in the millions, certainly in the high hundreds of thousands, but millions and tens of millions. So those are just simply decisions that we feel a human has to be involved with, and also the borrower wants a human to be involved. If they're going to be borrowing 10 or 20 or 30 or 40 million pounds from an institution, they sort of want to make sure that we're not a loan shark, and that they're borrowing money from an institution that seems to be doing things in the right way. And also from our perspective, we want to make sure that the business, that we feel comfortable with business, right? We're not in the business of lending money. We're in the business of being repaid money, as we always say. And a big part of that is sort of feeling comfortable with who you're lending money to, which is why one of the things we do for loans over a certain size is invite borrowers into credit committee and actually discuss their lending needs directly with the decision makers, because a credit paper can tell you, a lot of the picture. But it's very different when you see the white in someone's eyes and you can have a conversation with them and see how the leadership team is operating together. That can actually change the decision, which on the credit paper might say this is a yes, and then you meet them and you feel like actually that didn't bode well. and vice versa, right? There might be on the credit paper, you're sort of not really sure, and then you meet the team and you say, actually, you know what, we're feeling really confident about this team, and we feel you know, happy to go ahead. So you know, the face-to-face interaction at this size of lending, we feel is very, very important. That being said, of course, automation can be leveraged in so many other parts of the lending process, and we've talked about this from you know, the inputting of data, the gathering of data, helping with the scenario analysis, the monitoring, portfolio monitoring. So there's a number of areas where you can incorporate it, but for us, it's not on the credit decisioning.
Right. Okay, let's talk about interest rates, because you know, all of your businesses here started off in a world where interest rates were extraordinarily low historically, and now they are no longer low historically, and you all have to fund these loans in you know, in different ways. I know you all do, but what when it comes to funding of loans, what are sort of some of the capital market trends that you're seeing? I'll open up to anybody.
I'll pick up to start.
Sure.
So I think in terms of, I just probably takes about describe our model. So we're a non-bank lender. We access the capital markets in order to finance the lending that we do. We do that through securitizations, also with originating loans on behalf of other banks and other financial institutions as well. Look, I think currently, certainly in the UK, the RMBS securitization market is relatively open, which is a good thing. So the big challenge for us over the last couple of years as a non-bank lender hasn't been accessing capital. There's been capital available to access. The big challenge has been accessing capital that's competitive against the people in which we're lending against. And the big advantage for as interest rates started to rise sat with banks, and in the parts of the market that we operate in. So, for example, on the UK buy-to-let lending space, we compete a lot with savings banks. And you know, the majority of the lenders in the space are savings banks, with a few capital markets access lenders alongside them. And actually, we saw ourselves a big disadvantage immediately because banks weren't passing across increases in savings rates, and that whilst there's the capital markets increases in interest rates increased, so our costs went up. Our competitors' costs didn't go up in the same way as savings rates stayed low for a while. I guess the big trend in our space at the moment is that reversing. So we're seeing savings rates continue to go up now as banks are competing for savings from savers. But at the same time, capital markets rates have come down. Swap rates have come down relatively recently as well, and we're starting to see, I guess, a more normalization of the markets where those accessing wholesale funding are able to do competitively alongside savings institutions as well. So I think that's the big thing that we've noticed recently.
Christoph, Val, you want to chime in?
Yeah, interest rates are higher. I think that's the bottom line, and that means that our refinancing costs are higher, and in parts we were able to pass the increased costs to our customers, but I think the impact has been more felt towards the prime segment of lending. We are more in the near and subprime segment, and the impact of increased interest rates has been lower, and therefore we've probably been a little bit more sheltered than other lenders from the steep increase over the last 12 plus months.
Right, and
Yeah.
accessing the markets have been, the money is still available for you for funding?
Yes, there's ample of liquidity out there for debt financing. Spreads are very competitive still, and I believe what is required, for lenders to have confidence is that you have a proven business model. Profitability helps a lot, and so we do have great access to liquidity, and access to equity markets is much more difficult, but I think that's not necessarily an issue specifically that we are dealing with, but that's a more global issue that IPO markets are still pretty much closed. So equity markets are difficult, but debt markets are very much open and very liquid.
Right.
Yeah, I mean, look, Oak North, we have a banking license, so we fund our lending through primarily through retail deposits. So, like many banks, higher interest rates has resulted in higher profitability for most banks, and then certainly for a number of the neobanks has pushed them into profitability for the first time. So I think it'll be interesting to see when rates normalize, whether how their models how their business models fare, and will they remain in profit when rates sort of normalize because they found those other parts of the business, other business streams or revenue streams, or will they sort of go back into the red if they're not able to to kind of keep if rates obviously don't stay where they are currently. So I think that's something that we will expect to see from our borrower's perspective. Obviously, for certain types of businesses, it's trickier, right? Higher interest rates mean for millions more people have higher mortgage payments. That means they have less disposable income, less discretionary spend. So for areas such as restaurants, hotels, leisure, hospitality, retail, it can get a lot trickier, and they're less sort of recession-proof sectors than say a nursery or a care home. So I think when rates normalize, that will hopefully mean that for a lot of those businesses that are more vulnerable to it, to sort of lower consumer spending, that they will see they'll see their sales and revenue return to what they were previously.
I always like how people are saying when rates normalize. I mean, rates might be normal. Knows what normal is.
Yes, this used to be normal.
Has been a completely normal rate like a few decades ago.
Right.
So I wouldn't necessarily expect the rates kind of to go on.
We don't. We simply don't know. We've gotten so used to really low interest rates. I mean, it's beyond the scope of this discussion for the future of interest rates, but that is a question that will be resolved in time. We will see. But anyway, I want to talk about customer experience for a second. And Rod, I want to turn to you. And when you've got a borrower coming to Lend Invest, what are you doing to improve their customer experience?
Yeah, so I think if you've taken a mortgage in the UK, I talked earlier about some automated credit decisioning and credit scorecard that ultimately means computer says yes or no. But if you take a mortgage in the UK, you're still likely to have to sign something with a pen. You're still potentially, with a big bank, likely have to put something in a post box. You are likely to have to get documents certified by a solicitor. You're likely to have to print off a ton of bank statements, often getting them wrong and then reprinting them off under a different, for a different data period. All of those frictions, exist, and that's before I've got to legal conveyancing or valuation and all the rest of it. So, there's a ton of friction in the UK mortgage market. I think probably worse than most markets, mortgage markets across the world. And what we do really is try and automate as many of those frictions away as we can and improve the experience for both the broker and the underlying customer. So the UK mortgage market's a heavily intermediated market. About 90% of mortgages go through intermediary. So reducing the workload for the intermediaries is as important as reducing the workload for the underlying customer. So we'll use, for example, open banking. So 75% of the cases that come through on our residential owner-occupied mortgages will come through using open banking. And that's because our customers will often have more complex income. So it could be a doctor, multiple sources of income. They can get a mortgage, but if they want to get all of those sources of income recognized for their affordability, they probably can't do that with a high street lender. So they have to go to a specialist lender. If they're going to a specialist lender, most of the time that specialist lender is asking for a pile of PDFs to demonstrate that they can check through all the income adds up. We'll use open banking and that will get done automatically. So around 75% of our cases will come through using open banking and avoiding all of that PDF of bank statements. Of course, using DocuSign and not requiring customers to wet ink sign anything, to using doing KYC AML on customers' mobile phones. So I guess what is now very simple technologies, but in the UK mortgage market haven't even now really been fully adopted. So what we're doing is piecing all of those things together to create a better experience for both the underlying customer and also the broker too. I guess that's been a particular area of focus for us over recent months. Is how do we create a better experience for the broker themselves? So a big part of our development recently was relaunching our broker portal, give those brokers more transparency on the cases that are going through in their names, manage their accounts with us in a much more transparent way.
Mm-hmm. Interesting. So let's talk about open banking for a second. It's really began in the UK many years ago, but it's become fairly normalized now, I imagine. But let's talk about when you look at open banking, what are the trends that you're looking at, and what do you want to focus on for next year? Anyone?
Shall I start quickly on it? When we're using open banking, we're using it very specifically to verify customers' income. I guess the key for us is using it specifically rather than pulling a ton of data and trying to draw conclusions from all of the data that we're pulling. And I guess one of the big challenges for us in open banking space has been clearly we need customers to opt into that process. We're successful on the residential mortgages side because it really does significantly reduce the friction to those borrowers. But a buy-to-let landlord, for example, is much more reluctant to opt into an open banking process. So we have much lower levels of adoption there. So I guess the key thing for us is trying to continue to educate brokers, borrowers on the benefits of open banking to them. And ultimately for us, it's a huge benefit because effectively we've automated a ton of internal processes. So the cost of processing a loan going through open banking compared to a loan not going through open banking is material.
Yeah. What about in the SME space?
We've been using open banking since the very inception, which was 2019 or so.
I think it was 2018, I think.
18.
Yeah.
So it's been many years that we've been using open banking. We actually initially got a license ourselves and built it ourselves, and then over time have started working with specialized providers who are better equipped than we are in dealing with all of the sort of various integrations with all of the banks. So that was an interesting trend from building it ourselves to then outsourcing it to specialists. And then from a customer perspective, we're quite agnostic whether we receive banking data through open banking or them uploading PDF statements, which we're then automatically reading, or whether they share this to their accountancy software integrations that we have through which we get banking data as well. So, coming back to customer experience, we're really led by the customer, and some customers prefer the digital touch, but then there are many other customers who also prefer to upload information rather not have that digital connection. After all, your banking relationship is still something that has a bit of a special place in people's heart and mind. Yeah, nothing kind of like super concrete. It's just trying to educate people more of the benefits of open banking. It is more seamless. There are benefits for us if they connect, because we get a longer history than if we ask them to upload information. And we also have continuous access, which means that the products we can offer them are based on continuous underwriting based on that information. So there are a host of benefits that we can offer with open banking, but not everyone has chosen to use it yet.
Yep.
It also doesn't apply to everybody, right? It's much more from the business perspective. It's much more on the sort of micro, small business lending side at the moment, sort of closer to where, the consumer lending is. Obviously, there are benefits to us in certain ways. So we certainly use it on the retail side of our business. So, for example, with our savings products, we partner with TrueLayer. We use open banking to enable customers to quickly and easily move their money from their nominated account to their savings account, and obviously creating that seamless customer experience then hopefully means they will stay with us for longer. They'll deposit more with us, and then obviously that helps with our funding, our lending. So there are still benefits we can get in that way, but on the lending side, nothing directly given the loan sizes that we're doing today.
Yeah, understood. Okay, we're going to get to audience questions in just a minute. We've got quite a few coming in here, but before we do, I want to talk about embedded lending, because this is something that continues to become more and more important. What are you guys seeing when it comes to trends? What are you looking at for 2024?
Yeah, Mark. So I think we continue to see embedded finance grow. I think there's an EY report that said it's going to hit 600 billion by 2025, and I think that certainly an area of focus from us is, I guess, also the role that banks play in this. So your traditional banks, are they an enabler for this? Are they a builder for this? Because I think we're starting to see more and more players in an embedded finance perspective kind of come to the fore. I think we're also seeing, I guess, from a integrated customer journey, the quickness in which you can check out now and choose that embedded finance option, it is worlds apart from where it was maybe 2-3 years ago. So we're certainly seeing that those seamless integrations and I guess that interconnected customer journey being driven through that demand for customer experience.
Okay. Yeah, I can only echo that from our experience. We started building up our embedded finance capabilities in 2017, so it's about 6 years ago, and are now reaching through the various parties that are using our API, probably about 2 to 2.5 million businesses in their sort of environment. And those integrations range from strategic partners like eBay, who are offering financing to their sellers through us in a fully embedded way, to accountancy platforms, credit marketplaces that make very heavy use of our API infrastructure to provide the instant decisions, automated decisions that I alluded to earlier on in the marketplace directly, which is still unique. We're the only company who can provide that level of automation in an embedded world. And with iWalker Pay, the checkout product that we launched in 2023, we had about 1,000 merchants sign up to use iWalker Pay and offer payment terms to their customers, which essentially is the purest form of embedded finance, of giving the ability to any business to offer flexible payment terms of between 90 days and a year to their customers, so that they can pay kind of their purchase in their own time that works for them, while paying the merchant upfront through us. So very, very interesting field, and one that I think has a lot of room for us to continue to grow in.
Yeah, I would echo that. I think, huge opportunity for banks, both sort of very large incumbents through to smaller community banks. Examples, obviously, fairly recently, Shopify announced Shopify Credit, so a business credit card for its merchants, exclusively for its merchants. And I believe the bank they're using is Celtic Bank. But then, of course, you've got the sort of behemoths like Amazon that has been offering loans to its customers for a very long time, and I believe they use Goldman. So you have very large blue chip brands that could work with very large blue chip banks, and then you have Shopify definitely a blue chip brand, but sort of smaller commerce banks that can then also benefit from an increase in embedded lending. So absolutely an area that that's very exciting, and that opens a lot of doors both for fintechs like iWalker, but also for for banks.
Right. Okay, so we want to get to audience questions here. First one, what are the general trends the panelists identify in their respective markets, both in terms of loan demand and supply? Are banks further pulling back? Are there other new entrants coming in?
So I can have a go at that. I think, just for those in the audience who may not be aware, the place that Oak North operates in, we sort of say we lend to the missing middle. So businesses that we feel have been have reached a certain scale, are profitable, have reached a certain growth stage, and are looking for capital to grow their company. But their needs are typically overlooked or underserved by the traditional banks, and so loans will be, as I say, typically in the millions of pounds, if not tens of millions of pounds. And absolutely, we're seeing traditional banks pulling back or retrenching. It's not necessarily that they say we're not lending to these businesses overall, we're not lending to SME overall, though those numbers are falling. It's more that they will veto certain sectors. So they might say we're not lending to retail right now, or we're not lending to hospitality and leisure right now. And obviously, that blanket approach doesn't really work. I mean, Oak North, we take a very different approach. We really look at the individual business. Even if you look at, let's say very large scale retail supermarkets, for example, right now with the cost of living crisis, Waitrose is seeing a decreasing number of customers. And meanwhile, budget retailers like Aldi and Lidl are seeing, increasing customer numbers. So, to say every supermarket chain is doing badly would obviously not be correct. Equally, we have in our hotel portfolio, for example, we have airport hotels, we have boutique hotels in the Lake District, we have chain hotels, chains that are in sort of central London. So the performance is going to vary significantly between each of those types of businesses. So being able to take a very granular and build up a very granular picture and granular performance of the business is so crucial. That enables us to continue lending, and we have continued lending. And that's not just through the last 12 months, but all throughout COVID, throughout Brexit. So I think we know from our customers that they have felt that their banks their doors aren't open, that they're much more of a sort of fair weather friend. Which obviously creates an opportunity for lenders like ourselves to potentially gain more market share in times like this.
Okay. Another question coming in. We haven't touched on this, but so what benefits would you expect for your business or customers from the adoption of public blockchain technology at any part of your value chain? Anyone want to take on that? Is there anyone doing anything there?
I'll start. I look at that. It's probably not even public blockchain, but one of the critical issues in UK property space is just standardization of data. And before we get to blockchain impacting land registry, for example, that would be fantastic if we could get there. But before we get there, we need to at least standardized data that the industry adopts and uses. But I think ultimately, blockchain could have a massive impact if applied to land registry in the UK in particular, where the land registry is so bad. The title takes many months to be registered post an acquisition, which is incredible, really.
Anyone else doing anything on the blockchain? No. Okay. Let's do this. So, okay, I'm just going to go back to interest rates just for a second, because there was a question coming in. This was directed at you, Val. What do you consider normal interest rate levels?
So I think, we kind of had a little bit of this, before with Christoph. I would, obviously where we were previously wasn't normal. That was an extreme situation that just ended up lasting much longer than anyone had expected post-financial crisis. But I would say, yes, perhaps where we are interest rate wise today isn't abnormal, but it's the speed at which we've got here. Right. That hasn't been very normal, and that has then created the ripple effects across the industry that we've seen. What we would expect to be more normal in the future is that should interest rates change, it will be probably much smaller and less frequent than it has been, and that gives the market an opportunity to to react in a more normal way. Right. So that'd be, I couldn't say where I think normal is, but I think that it's more the speed at which they change and the frequency in which they change that will normalize. Okay, so I want to end with hearing from each of you about what the single most important trend of 2024 that you consider, that you're paying closest attention to. So, Lewis, why don't I start with you?
Yeah. So I don't know it's the single most important trend, but certainly one that we're paying close attention is around kind of consumer duty and responsible lending, particularly around, I think we mentioned embedded finance. The access to credit now is so freely available everywhere. So I think we're certainly looking at the role technology can play in ensuring we are lending responsibly. Okay,
Rod?
So 2024 is going to be an election year in the UK, and I mean, one thing's for sure is government policy has a direct impact on property market, and so one thing we're sort of paying very close attention to is politics, probably more than we would do in a normal year. Starting to see some policies coming forward from either party that can have quite direct impacts on the property market, both good and bad. So that that's something we keep a close eye on.
Right. Val?
Yeah, I would sort of say consumer sentiment or confidence. That's something that, as I say, and I referenced before, if you have a less disposable income, less discretionary spend, then that will impact a number of sectors and a number of businesses much more heavily. So looking at that, seeing how consumer finances are being impacted by inflation and interest rates, and then how that creates ripple effects down through our loan book. That's something we continue to monitor very closely.
Okay, Christoph.
There's so many trends and so much uncertainty in all of these trends. The one sort of trends that I think I've been backing with everything I have over a long period now is that you can see that all of these more innovative lenders that really invest very heavily in giving the best experience to customers are getting more market share. And they are becoming ever more important to the ecosystem in which we are all living, and so I think that trend will continue. I think banks are slowly but surely losing some of their ground, and will become ever more a refinancing infrastructure than necessarily the front to customers. That is a long trend, but if you look at the last 5-10 years, the environment has changed significantly, and I think in our world in SME lending, probably about a third of SME lending is now provided by non-banks, and so that share has significantly increased, and I think we'll continue to do so. So that's the trend that I'm betting on, and cutting through all of the uncertainty and noise that is around it.
Right. Well, that's a good place to end it. So thank you very much, everybody. Thank you, Lewis, Rod, Val, and Christoph. Thank you to Provenir for sponsoring this session. Of course, thank you for the audience for tuning in. Appreciate your time. Have a great rest of the day. Thanks, everybody.
Thank you.
Bye.